Okay, good morning, viewers. This is your tutor, cpacertification, and I'm here to take you through economic environment, and we are going to be handling a topic of inflation, that is economics of inflation. And I want you guys to subscribe to this channel. Make sure you comment if there is something you want to get clarity on, then you can use the comment box, or you send me an email, or you send me WhatsApp, because the WhatsApp numbers, they are there on the screen. We can see how we can help each other for better understanding. So allow me to proceed. Inflation, this refers to the persistent increase in the general price level of goods and services in the economy in a given period of time. Inflation is, when you're defining the inflation, you make sure you put the word persistent increase or continuous increase. It's a time where the inflation or the prices of commodities, they are increasing on a continuous basis, depending on the factors we are going to see, which force the price of goods and services to be increasing in a given period of time. If, let's say, you want to determine what is the rate of inflation between, let's say, 2 years, you compare the present year or the current year price, you deduct the previous year price or the base year price, then you divide by the base year price or the previous year's price, then you multiply by 100. That's how we get the rate. When the percentage is exceeding 100, we assume that the inflation has been, if, let's say, you want to determine how the general price level of goods and services have been increasing in a certain period, you make sure you deduct the 2 periods we are comparing, then you divide by the previous or the base year period. So I want to know, what is the state of inflation? The state of inflation, it is just the rate or the number of times the general price level of goods and services or commodities is increasing at a given period of time in an economy. So we expect that when we talk about the state, we are just giving the rate at which the interest is increasing in a given period of time, or the number of times the prices are increasing. This refers to the rate at which the general price level of goods and services or commodities are increasing in an economy at a given period of time. So I want to look at how we can classify this state, or how we can classify inflation according to the rate at which the increase is growing. If it is a very high rate, then it will be the hyper or runaway inflation. If it is growing at a slow rate, then we shall be seeing what are some of the advantages that are there when the general price levels are increasing at a slow pace or at a slow rate. And we shall also see what will be the disadvantages of this inflation if it grows at a very high rate. We are talking about the classification of inflation according to the state or the rate at which the inflation is increasing in an economy. We have a mild rate, can call it a creeping or gradual. Gradual means it something that is following a certain step. It is increasing but not at a very high rate. Or moderate. Moderate is something which is in a bit in the middle. It's not too high, it's not too low, it's somewhere there in between. So mild inflation or the mild state of inflation, this is where the persistent increase in the general price level arises at a slow rate, usually not exceeding 10%. If it is not exceeding 10%, then we expect that state of inflation is a bit good. Why? Because when the prices are increasing when the prices are increasing at a slow rate, we expect that at least it is going to be like a motivator for people to work hard so that they can be able to earn a living. When the prices are increasing, they also facilitate the producers to produce more goods, because at least by that time they will be making more profits, which makes that state of inflation to be a bit good to the community. But when it goes beyond the 10% we are talking about, then you'll just know that inflation is bad, because at the end of the day, when the inflation is increasing at a very high rate, we expect that people, they will prefer to hold the real goods than having money, because you may find when the prices have increased, you have to carry more money to buy small things or few goods, and the impact is because of the increment in the prices. The second state of inflation is the hyper, you can call it runaway or galloping inflation. This is where the persistent increase in the general price level of goods and services increase at a very high rate, and the percentage increase is like the rate at which the inflation is increasing. It is increasing per hour, per day, per week, whereby if, let's say, you bought a certain item, let's say you bought a laptop at, let's say, at a cost of 1 million, when you go there to the next day to purchase the same laptop, you may find that the price has increased by 200, and it is now, the selling price is now to 1.2. That 1.2, that difference between 1 million and the current price, which is the 1.2, that difference of 200 is the one that we call the increase in the price as a result of inflation. This, we say the percentage increase is that it is exceeding 20% per annum. You see that per year, you find that the percentage or the prices has increased more than, meaning if something is increasing by 20%, it means the total percentage is supposed to be 120, meaning that amount is supposed to exceed the 100. If, let's say, if the current price, if let's say the price, the old price before the increment was, let's say, 1 million, and someone says we had an inflation of 20%, we expect that it is going to be 120 over 100 times the 1 million, meaning it will be making up the the total price to be 1.2 as a result of an increment in the prices. So at this rate, we expect that money is going, first of all, money is going to lose the total value, and people will prefer to hold goods than getting money, because it doesn't make any sense for you, let's say, to buy a laptop today at 1 million, and when you go back tomorrow to buy another one, you find it is 1.2. First of all, if let's say you are a producer, you may find that even if someone wants, let's say, to buy a certain amount of, let's say, certain stock, let's say you want to buy 10 units of laptops, and you find that the prices at which someone took an order, let's say today or yesterday, you may find that the price when that person comes back the following day, you find that the person cannot even access what that person bought, let's say, yesterday. That's what we mean. And if someone cannot do that, then it means even if you receive that money, it will not be of help, because if, let's say, you are a wholesaler and you are buying these laptops at 1 million each, and you are selling them, let's say, at 1.2. When you go back to, if let's say you've bought, let's say, 10 units and you've sold all of them at 1.2, let's say you bought those goods today and you sold them today. If you go back to your supplier and you find that the laptops, they have increased, the ones you bought at 1 million and you are selling them 1.2, you find that now you are supposed to pay 1.3. It means even the money you got from the customer or from the sales you made last time, they are not even capable of getting for you another stock. Because if the customer paid you 1.2 and now they are telling you to purchase one, you are supposed to be having 1.3. It means it's like you made a loss when you sold those goods. So that's why we are saying when the inflation is a bit high, we expect that people, they don't want even to hear about the money. They rather keep their stock and they build stock, because at the end of the day, if you lose the stock, when you want to buy the stock again, you may find that the price you are going to be incurring is more than what you actually even got. So that's how I can explain the state of inflation. It is given in two categories: the one which is growing at a slow rate and the one at a high rate. We said the one which is growing at a slow rate, that's the mild inflation. That one is good. And the one which is growing at a very high rate, that is the hyper inflation. It means that one is not good for the economy, because we expect that the money is going to be losing value every time, and it will also discourage production, because the consumers, they also be reluctant to buy those items because the items are of a high price. Then let's look at classification of inflation according to causes, how this inflation comes in. We are going to look at different types of inflation, and we look at it in the sense that we are looking what causes this increment, or what causes the prices to increase for a certain product. The first one we are going to be looking at is demand pull inflation. Demand pull inflation, this is where the persistent increase in the general price level arises out of excess aggregate demand for goods and services over aggregate supply at a condition of full employment. Here, the things we are going to be talking about is, one, there is excess aggregate demand. There are more people who are willing and able to buy the goods. Secondly, there is a low aggregate supply, meaning that the people are willing to buy the goods, but the suppliers or the goods themselves, they are not there. What causes that is this condition of full employment. The condition of full employment is all about, if let's say, I can use an example of raw materials. You've been getting, let's say, natural, you were engaged, let's say, in cement industries or manufacturing, and you find that the raw materials you've used, they are no longer existing. Let's say the certain rocks or particles you've been using in the production of that cement, they are no longer there. Then we expect that you have overused the raw materials, and now the raw materials is no longer there. So it means if the raw materials, they are not there, we expect that you are not going to be producing. And when you are at that point, we expect, we say that you are at full employment, meaning all the factors of production, they have been used up to their maximum, to the extent that if you want to produce more, you have to look for other sources. That's what we mean by the demand pool inflation. That demand pool inflation, for it, we said it is excessive aggregate demand over aggregate supply at condition of full employment. When you're explaining, make sure you don't forget those factors, because if you stop at, let's say, excess aggregate demand for goods and services over aggregate supply, and you don't put at a condition of full employment, we expect that you have done nothing, because we want to know what caused these supplies to be not enough for the demand which is there. So we have an illustration here, and it is, we have the prices and we have the quantity demanded. What you are seeing here is, this is a demand curve. We say the demand curve has a negative sloping. So you are seeing it as it slopes negatively. So we expect that when the demand, as you are seeing AD1, this is aggregate demand 1, aggregate demand 2, aggregate demand 3, and the aggregate demand 4. So we expect that when the demand is increasing, as for the business, we expect that when the aggregate demand is increasing, we are also expecting that the supply is going to be increasing too. When it is at that point, we expect that at least there we have a mild inflation, or the rate is not a bit high. So what happens is that when the aggregate demand exceeds the supply, you see from AD1 to AD3, we expect that we assume that the organization has achieved a full employment. That's why here you are seeing at AD3, we expect that this quantity is at full employment, meaning that is the only quantity we can supply, even if the demand increases to whatever value. So we are saying an increase in aggregate demand from AD1 to AD3 is accompanied by higher output, because you are also seeing that the output is changing from Q1 to QF. That's where the quantity, they are also increasing in that range. And as a result, we expect that the prices, they are also increasing, because when the demand is high, we expect that the suppliers, they are going to be increasing a bit in the price so that they can maintain or they can maximize more profits. So As the quantity is increasing, the price, they are also increasing from P1 to P3. So upon that level, meaning at this point, we expect that the economy is going to attain a full employment. All the resources are going to be used up, or everything is supposed to be at the maximum. When we reach that point, then we expect that even if we demand more, like from AD3 to AD4, the only impact will be that the prices are going to be increasing from P3 to P4, but we don't expect the quantity to increase anymore because we've attained the full employment, or every item or every resource or every factors of production, they are all maximally utilized. So we expect that when we reach at this point, whatever demand that is there is going to be at a constant output, but rather the prices are going to be increasing and increasing, which causes the hyperinflation. Because from OP1 to OP3, at least there we expect that we had a mild inflation because the quantity was also increasing. But the other side, we are seeing we have utilized all the resources. Now the only thing which is going to be increasing is the price, because when the people, they are demanding more, you expect that for the suppliers, for them, they will just be setting higher prices to achieve more profits. And that's what we mean by the demand pull inflation. It is the excess aggregate demand for goods and services over aggregate supply. As we've seen that upon this point, we expect that the supply is going to be constant, same number of units we are going to be supplying, but at different prices. So I wanted to talk about what are some of the causes of demand pull inflation. What causes these prices to increase? Saying demand pull inflation. What causes? First of all, we want to look at what causes the excessive aggregate demand. What brings the demand to be a bit high? We expect that one, there is an increase in money supply. How do we increase the money supply? Of course, we have those other monetary policies which helps to increase the money supply. If let's say the bank rates, which are charged by the central bank, they are a bit fair, so people can easily get money, and money is much in the saturation. So we expect that if there is an increase in the money supply, then we expect that since people have the money to purchase the goods, then that one will cause an aggregate demand, because at whatever price the producer may set, clients, they will be willing to buy the items because they can access it. Reason, there is money, which causes, and as the prices are increasing, we expect that the inflation is coming in. The other thing we can talk about is increase in the population growth. When the population is growing at a very high rate, we expect that these people, they are going to be demanding more goods for consumption. So when they are demanding more goods, we expect that the producers, they are going to also increase the price, because what they can produce, people can buy it. So to make sure that for them, they make a lot of profit, they increase the price. As they increase the price, we are assuming that that increment will cause an inflation, because if, let's say, the population was growing and the production was okay, then we wouldn't be having this problem, because what the producers will be producing, they will be in the same way or in the same proportion as to the people's demands. But if you find that the producers, they cannot even produce what the population can consume, then we expect that there are going to be an increment in the prices, which will cause demand pull inflation. The other thing we can talk about is increase in the disposable income of individuals. The disposable income is that money that someone remains with after they have made these other statutory and non-statutory deductions. If, let's say, someone has been receiving salaries. So when we expect that the disposable income is going to increase, it is increasing as a result of people being paid a lot of money. If there is an increment in the salaries or wages for workers, then we expect that people are going to be having enough disposable income, which will make them to demand for more goods which are not available in the market. So the other one, we can talk about increased exportation and a decrease in the importation of the scarce resources. The resources we have in the country, they are few, but on those few we have, there is exportation. We are trading them out to other countries, which makes those resources to reduce in value. As they reduce in value, we are attaining the full employment. But remember, some people, when they are exporting, for them, they are interested in getting the money, but at the expense that they are not even importing some of the other scarce resources. So by the time they export, they may export all, and we remain with nothing because we've given it out and we've not bought anything from there. So at that point, we expect that you are going to attain a full employment and there will be an increase in the demand of which you can't even satisfy. The other thing we can talk about is increase in the government expenditure. This government expenditure may be in form of, let's say, the government is subsidizing these, let's say, the investors, the customers, and they are giving them something. When they give them something, we expect that something they are giving back to the public is going to increase the money supply. As the money increases in the circulation, we expect that people are going to be able to buy whatever they want at whatever price, which will cause an increase in the price, which will result in an inflation. So let's look at some of the solutions to demand pull inflation. Demand pull inflation, one way we can control it is because we are trying to look at, if you look at the causes, then you look at what are some of these possible solutions to the causes. One of them will have use of restrictive monetary policies. I said if you are increasing the money in circulation, you reduce the bank rate. Let's say you buy securities, treasury bills and bonds. The government buys the treasury bills and bonds from the public. There you are increasing the money in circulation. So if you want to reduce the disposable income of the people, you have to use the restrictive monetary policies. And this may include an increase in the bank rate. When you increase the bank rate, it means those bank rates are going to make people reduce on the rate at which they consume those loans. So when they reduce, automatically we expect that the money supply is also going to reduce in the public. The other thing you can also sell, like for the government can sell public all those treasury bills and bonds to the public. When they sell them, you are trying to get money out of circulation. So when you use that, you can reduce the money supply, and when you do so, we are expecting that even the disposable income of the individuals is going to reduce. As it reduces, it will also reduce the aggregate demand. The other thing we can talk about is use of restrictive fiscal policies. These fiscal policies, they are in terms of, we are talking about loans, taxation. Then we expect that the government should also increase on the direct taxes. We are talking about direct taxes because these direct taxes, they are the ones the government used to deduct money directly from someone's earnings. When they increase that one, then it means they are reducing the disposable income of the individuals. When the disposable income of the individuals are reduced, so the individuals or the customers are going to be left with little purchasing power, which will eventually reduce the aggregate demand, hence controlling the demand pull inflation. The other thing we can talk about is the use of trade policies. The trade policies, as you hear the word is trade, means buying and selling. So in this scenario, if you want to reduce the demand pull inflation, one, you are going to make sure you increase the importation of the scarce resources. When you increase the importation of those scarce resources, then we expect that you are supposed to reduce the exportation of the scarce resources. When you do so, you are making sure that instead of attaining the full employment, we make sure that we continue producing and make sure we produce the goods that can serve the excess aggregate demand or the excess demand for the goods. So when we increase the supply, the aggregate supply, we expect that we are going to be reducing inflation. The other one we can talk about is the use of wage freeze policy. This wage freeze policy is all about minimizing the way you can control the wages in terms of setting minimum and the maximum wages. But at this point, when you want to control, because we are sure that people have money because of the increased salaries, so want to set a maximum, you set a maximum wage whereby that no employee is supposed to be paid above this amount. When you do so, you are reducing on someone's disposable income, which will eventually lower their purchasing power. So when we use these wage freeze policies, we make sure we set a maximum wage legislation to reduce on the salaries or on the demand for more salaries for the workers. And when we do so, we've automatically reduced the inflation. The second last we can talk about is use of price controls. These price control procedures or policies, here we are aiming at setting minimum and the maximum prices. But since here we already know that the prices are keeping on increasing, then we have to set a maximum price whereby when we set a ceiling or we put a climax that a price of a certain material is not supposed to exceed this level. So when we do so, when we put the maximum price, then we expect that we are going, instead of having an increment in the prices for the goods and services, we have where the price is supposed to end. By doing so, we are reducing the inflation. Last one is use of production policies. These production policies, we are aiming at increasing the production. How are we going to be doing so? We may say that certain statutory organization, let's convert them to private sector so that we engage more people to produce the goods for personal consumption. Then the other thing, you can also reduce on the procedures which someone must follow to make sure that they set their companies, so that when you reduce that, we are expecting that more people are going to be engaged in the production, and as they do so, we are expecting that they are going to reduce the demand for the commodity by supplying whatever is needed in the market. That's all about the demand pull inflation. Allow me to talk about the second classification of inflation by causes. The second one is cost push inflation. As you hear the word, it is cost push, meaning it's the cost of, let's say, the factors of production causing an increase in the prices of the commodities. Because you know from the costing concept that when the cost of the raw materials are increasing, we expect that those costs are going to be transferred to the final consumer, in that those costs are going to be included within the selling price, because having known the cost, you can determine the selling price. When the costs are high, you expect that the costs themselves, they're already high, but someone has to add a profit component to that cost so that they can set a selling price. So when the costs are increasing, we expect that when they put a profit component, the costs are going to be higher, which will make the selling price to be high for the goods. But that came as a result of the increment in the costs of production. This is where the persistent increase in the general price level arises out of increase in the cost of production. And when we talk about the cost of production, we mean these factors of production that are used in the production. As you know, labor, capital, entrepreneurship, and others, as you know them, the factors of production. So when these costs increase, then we expect that the price for the commodity is going to be high. For example, increase in wages. If, let's say, workers are demanding for higher pays, if the interest rate is high for the capital they have borrowed, if the rent is high, if the price of raw materials are high, then we expect to be having a high price for the commodities. We said the cost is shifted to the final consumer in form of higher price of consumer goods. So when the cost of production is high, that cost is transferred to the final consumer, and it will be the final consumer to bear whatever price they have set. So from the graph, we are seeing that there is a continuous shift in the supply curve as you are seeing here. From S1, this is a supply curve, S1, S2, S3. Those are the supply curve. Meaning, if there is a shift in the supply curve to the left, we expect that that is a decrease in supply. If the supply curve is moving to the left, if it is moving to the right, then that is an increase in supply. But since it is reducing or moving to the left, then we have a decrease in supply. But that decrease in supply comes as a result of an increase in the costs of production. When we see here, we are seeing that the reduction from S1 to S2 was as a result of an increase in the prices of the raw materials from P1 to P2. The same as for S3 and S2, which were as a result of an increase in the price. Because at this point, we expect that the demand is going to be constant for those items. Let's say you are producing units to, let's say, 10,000 people. Those 10,000 people, they are going to be constant. This is our demand. It is constant because we are giving to the same population. But these costs for them, they are increasing. So when they increase, you expect that you have also to increase the price. When you increase the price, then you are going to be selling less quantities. That's why here you are seeing as the supply curve is also reducing, we expect that the quantity supplied or demanded is also reducing. That's what we mean by that. But it is reducing because of the increment in the prices, and that increment in the prices was as a result of the increased costs of production. So I want to talk about something here about these are some of the causes of cost push inflation, but they can also be forms whereby these causes, they are in a form that each of them has a different item that causes them to increase. That's why you may call them forms or causes of cost push inflation. The first one, you have the wage push. We are starting about the labor. If the labor is demanding more pay, then we expect that the price is going to be high. We are saying wage push inflation. This is where the increase in the wage rate exceeds the productivity, or the increase in the wage rate exceeds the increase in the productivity. This leads to reduction in the supply, because it doesn't really make sense for someone to be demanding for a higher pay or someone to be paid highly, and yet when you compare the production, yes, we are increasing your salary, but when you compare what you are producing, you are not producing anything. You are not adding. Yes, we are adding you salary, more salary, but what you are producing is not increasing as to the expectation, because when that happens, we expect that the supply, first of all, is going to reduce because we're not producing, but the money we are paying you is increasing every time. So it will, first of all, create a reduction in the supply. When the supply reduces, then we expect, since your wage is increasing every time, we expect that as your wage increases, then it will also increase the prices for those commodities. Because at the end of the day, if you had been producing well, then the prices would be normal because the supply will be there. But we are paying you highly, but there is no increase in the productivity of the workers. That's one of the causes. The other one, we can talk about wage to wage inflation. This wage to wage inflation, this occurs as a result of intersexual comparison of wages in workers. This happens if, let's say, these people, they are working in the same sectors. If, let's say, someone is working, let's say, in a manufacturing company, let's say Coca-Cola, and the other one is working in Pepsi-Cola, they are in the same sector, so they compare the salaries they are getting, because it will be the same thing that a marketing officer in Pepsi-Cola, they want them to have the same salary like the manufacturing or the marketing officer in Pepsi-Cola. So if they compare their salaries and they see that they are not the same, then they will demand for a higher pay. And that higher pay will come as a result of the comparison that was made between the people who are in the same sectors. So we said this occurs as a result of intersectional comparison of wages in workers. This increases wages in one. This means the increase in wages in one sector or firm causes an upward revision of wages in similar occupations in the economy. As the entrepreneurs demand more wages, we expect that the cost of production is going to increase. As it increases, then automatically it will force the price of the final products to be high, which causes inflation. The third one is wage price inflation. This wage price inflation, this occurs when workers demand for high wages through their trade unions. You know, these trade unions, they are those, let's say for the medical workers, and medical workers, let's say they go on strikes. When they go on strikes, they use their own trade unions to demand for more pay. These trade unions, they are organizations which unite people who are doing the same, almost the same, or who are in the same line of business. If, let's say, they are doctors, or if they are teachers, they have their own associations which unite them, and they can, because when they are very strong enough, they can be in a position to bargain for the higher salaries for their members they are representing. So if that happens, then that increment in the wages will make an impact on the prices, because it will increase the cost of production. That's how it is with the wage push, or the wage price inflation. It is as a result of workers demanding for higher pay from their trade unions, meaning it is not directed the workers. Then second last, we can talk about price to wage, that is spiral inflation. This price to wage, this occurs when there is an increase in the price of the commodities, leading to workers to demand for a higher pay or a higher wages or salaries. Here we are saying that when the prices increase of the commodities, these workers, they will also see that as a point that these people, they should also be increased, because what they are producing has increased in value. So they expect that as what they are producing is increasing in value, then they should also be paid more. And if that happens, then you just know that it's going to pile up the cost of production, and in the end will cause the prices of the final products to be high. But remember, this one is as a result of the prices, meaning if the prices are high, then it will cause workers to ask for more wages or for an increment in their salaries. The last one we can talk about is the markup. The markup inflation or the profit push inflation. As you are hearing the word profit push, meaning it is as a result of people making more profits, which causes the workers also to demand for higher pay. Profit push inflation or the markup inflation. This occurs when the producers or the monopolists restrict output with the aim of charging higher prices. Because the main emphasis of these people holding stock is as a result of them asking for higher prices. When they ask for higher prices, you just know that they are expecting to be earning more profit. So what drives them to restrict the output is for them to set a higher price and they earn a lot of profit. So it is the profit component that causes those people to hold the stock. When they hold the stock, they are creating scarcity. When they create scarcity, we expect that the demand is going to be high. So when the demand keeps on increasing, they will set a higher price, which will result into an inflation. That's all about the cost push inflation. Maybe we can look at how we can control some of these cost push inflation. The first one, the government can provide subsidies to producers. When, let's say, they give them something as an incentive to boost their production. Yes, we know that the prices are increasing, but the government may give them something which can facilitate at least, and it lowers that cost of production so that they can be able to produce those goods and they sell them at a favorable prices. But to do so, then it means the government has to come up with subsidies or the incentive schemes which can make them run at a low cost. Secondly, then we can also encourage the importation of the scarce resources, because we know that if the cost of production has been increasing because the raw materials has increased in price, one of the factors that may cause the raw materials to increase in price is when those raw materials are scarce, when those raw materials are very few. We expect that those who have them, they will be charging them highly. Like for labor, you may find that there is labor immobility. Workers cannot move from one location to the other. So it causes those who are in certain places to be asking for more pay because there is labor or geographical immobility of workers. So when you look at this, then you can say that we can try to import some of the scarce resources. We can import human labor, whereby you can be using, let's say, you'll be using people from abroad, depending on the cost. If you compare the cost, that if I get these people from outside, then they will not be charging me this amount of money, then you are good to go. The other one, we can import the raw materials themselves. If it is the raw materials which are increasing in value as a result of being scarce, then we can import others to supplement on what we have. Then the other one, we can also discourage the exportation, because when if the resources they are already cheap, they are already few, and you are exporting them out, you are creating the demand for those raw materials by continuous supplying them outside than using them in the production. So when we discourage, so we expect that we are going to be producing, we are going to be having the raw materials to produce those goods at a very low price, which will result in a low selling price. Then the other thing we can talk about is the wage control measures. As we said earlier, that you can set these maximum and minimum wage rates, and you regulate how workers are supposed to be paid. But this one, most of the times, is done by the government. If the government sets the maximum wage rate, then it will control workers. Even if they are demanding the salary through their trade unions, it will be a bit tricky, or it will be harder for them to demand more than the set maximum wage rate. Then there is, we can also use non-monetary benefits to the employees. Instead of giving the employees money, which will result in an increase in, let's say, the prices of the commodities, we may give them, let's say, some old company cars, company materials, and others. So long as you see that the person, that whatever you are giving the person can motivate that person, and the person can be able to make sure that is producing the rightful amount that is needed. That's all about the cost push inflation. Allow me go to the next classification of inflation by causes, and that is structural or bottleneck inflation. As we are hearing, the word is suggesting structural or bottleneck. Bottleneck, this one is used especially in manufacturing firms. If, let's say, a manufacturing company, let me use Coca-Cola. If, let's say, Coca-Cola has a machine, and that machine, let's say, is capable of making, let's say, 10,000 bottles of soda in a day, and you find that you have a demand, the demand is there, is exceeding the 10,000 this machine is making. We are saying that the increase, because it will make the final output, the 10,000 units, to be charged at a higher rate. Why? Because the demand is there and the supply is few, or the supply is a bit restricted, because the machine cannot be adjusted. Maybe to do so, to adjust the machine capability, then it will cost you to get another machine, of which getting another machine is adding another extra cost. So if the supply is restricted by the machine itself, then we are saying there is supply rigidity, but that supply rigidity comes as a result of not that the people, they are not willing to produce, but something cannot be adjusted. Because if the machine is capable of producing 10,000 units in a day, you cannot adjust even if the demand is there. That is what we mean by the structural inflation. This is where the persistent increase in the general price level arises out of supply rigidities in an economy, which keeps down the level of production. I hope you can understand that. And you can also talk about it in the sense of, let's say, in agriculture sector, because I know Uganda is 90% of the population is engaged in agriculture. You can talk about it in the sense that, let's say, there is no season for growing certain items. You may find that people are willing to supply those things, but they cannot grow them, or what they have grown is yielding less than the demand, because you cannot force the yield. If, let's say, you are planted and you have harvested a certain unit or a certain item, and that item is not enough to serve the population, then you don't blame anyone. It is because of the yield, it did not come out, and it's not because you wanted that to happen. That's what we mean by structural inflation. Some of the causes, we have poor performance of the agriculture sector. This poor performance of the agriculture sector comes in as a result of, because we are saying there is poor performance of the agriculture sector. This comes in as a result of, let's say, bad weather. We've said that, let's say it is time for harvesting, but the rain is still there. People cannot even harvest what they have planted, or it is planting season, but the rain is not there for people to plant. It's not their fault that they have not planted. If, let's say, there are pests and diseases, yes, we've planted well and we did everything, but these diseases, because we can't control them, you find that they naturally destroy our production, or they are floods, and you find that the total production is limited because of some floods which may happen. The other one, we can talk about breakdown of industrial sector. As you know, that these industrial sectors, for them, they use machines. These machines, they keep, whenever they are working, they keep reducing in their useful life. Something which has been, let's say, if the machine has been new and it has been producing very well, you may find as the time goes on, that machine starts to reduce its efficiency, and instead of increasing the productivity, it rather reduces the productivity because of the depreciation. It depreciates. So when there is depreciation of those machines, we expect that they are going to lead into a low production. And that low production is not because we wanted that low production to happen, but it is as a result of those machines which are getting older. So when that happens, it means they are going to increase the price of the materials, of the output, or the final products. The other one, we can talk about inadequate managerial and entrepreneurship skills. We lack the skill that is supposed to be added to increase the production. If we lack that, then you expect that the production is going to be low. When the production is low, you expect that that is going to increase the price of whatever limited output we've produced. The other one, we can talk about existence of political instabilities. When there are instabilities or insecurity in the country, that distracts or discourages investors, both domestic and foreigners, because you cannot be investing in, let's say, a country which has civil conflicts and other insecurities which can really make you go into losses if you put in your money, as in you're trying to invest in the country with the instability, those instabilities. So when that happens, we are reducing the production and we are increasing the prices. Then we have also speculation by business incumbents. This sometimes happens to these monopolists. If, let's say, someone has been in the market, is there alone, no competition, no what, for them, they just create that artificial shortage. That artificial shortage is as a result of those companies restricting the supply of certain items so that they can create scarcity. And when that happens, they will just know that when they hold those goods, then we expect that they are going to be increasing the price, because the reason as why they do so is that they want to increase on their profitability. Second last, we can talk about the infrastructure breakdown in form of, let's say, poor roads. The roads are very poor to the extent that even the items we've produced, we can't even transfer them to the people who demand them. That causes the increase in the price in those areas which are hard to reach, which in the end leads to inflation. But that inflation was a result of the infrastructure breakdown or the poor roads. Then the last one, we can talk about the scarcity of the raw materials. If the raw materials are very limited, we expect that we are not going to make good production. Then let's try to look at some of the solutions that we can put up so that we can reduce the structural inflation. One of them, we can talk about economic diversification. Economic diversification is we improve on our export sector. Export sector means you are going to set up more and more, let's say, industries which are going to produce good quality raw materials or good quality finished goods for exports or for selling outside the country. When you do so, you are able to earn more in terms of the foreign exchange, and we can use that money, because most of the things we face in low developing countries is that when we try to export our raw materials, because we are exporting raw materials in form of agricultural outputs and others, they are in form of, they are not processed. We sell raw materials. When we sell those raw materials, we get less. And when we get less, it means we are also facing the balance of payment problems or deficits, which in the end makes us we are losing a lot of materials, but instead of using those raw materials to produce our own goods, and we sell those goods at let's say at a better price, which is better than selling them in their own nature. So when there is economic diversification, we leave the thing of selling one item. We be having, let's say, if you have been selling agricultural raw materials, let at least add some additional, let's say, industrial processes, and so that we can process some of those raw materials and we produce them on a high quality so that we can be exporting them and we earn more. The other one, we can talk about encouraging local production. When you encourage the local production, it means you are increasing the production of the goods. If, let's say, you provide some incentives, let's say if someone starts up a company and it can, let's say, be able to produce 10,000 units, we are giving it this and this amount. If, let's say, you set a company, let's say, in rural areas, we expect that since you are going to be reducing rural-urban migration and removing the regional imbalances, then we are giving it this portion, depending on how that investment is going to be helping in terms of generation of employment and other, and how it is going to be contributing to the GDP of that country. So that's how we can talk about the encouraging local production. Then the other one, we can talk about ensuring political stability. When there is a stable when the economy is stable, we expect that it will create a favorable working environment for everyone, whereby it will be able to encourage more investors to come, both foreigners and domestic investors, so that they can invest in the production and increase our output. As the output increases, we are expected to be charging a less price. The other one, we can talk about improvement in the technology. When there is a better technology, we expect that we are going to produce more and more quantities of output, and they are going to be of a high quality. So when we do so, we expect that even those costs which were increasing as a result of, let's say, some factors of production, we may see that we are saving. You can be saving, let's say, the raw materials because you are using a machine. You may be using few workers and you're reducing on the costs of wages and salaries. Then we can talk about infrastructure development. The roads were hard to reach, and we tried to construct some of them, and when you do so, you expect that those people will be able to receive whatever we've produced. And when we do so, we are reducing on the price in those areas. Then the last one, we can talk about modernization of agriculture. We leave the other old traditional approach of waiting for the rain to come, then you make the plantations. You can introduce in the irrigation schemes and other applications like application of fertilizers so that you can increase the output than waiting and waiting. You start looking at the production yield of a certain farm, and you are seeing that really you've made an improvement in the way the production has come out. So that's how I can talk about the structural unemployment. Allow me to talk about a little bit about this imported inflation. This imported inflation is where the increase in the prices of goods and services, it arises as a result of importing items or materials from the countries which are already experiencing inflation. If, let's say, in Uganda, we've been having that increment or the prices are high, and some people come in and try to import goods from us, or if we export out our goods and people take them, and when by the time they reach there, we've already made them to buy these goods expensively. So when they buy them, just know they have to add their own price plus a profit so that they can be able, because when someone is engaging in importation, you just know there are other charges like the freight charges, insurance, and others. When someone adds up those costs, you may find that the cost is going to be increasing. When the cost is increasing, just know where they are taking them. They are adding also a profit component so that they can determine the selling price. By the time they do so, they bought, first of all, they bought the items expensive. They incurred some other incidental costs in relation to the purchase. And they are also putting a selling price, which makes the prices, the final price of the product to be high, in the end leading to inflation. How can we control that? The only way we can control those ones is by putting our own things. Like first of all, you can put import restrictions. You restrict the volume of imports. You may say that I'm setting a tariff. If someone, you're not discouraging people from importing, but you put, let's say, a tariff that if you want to import certain items, we charge you, let's say, we charge you a lot of money on giving you those licenses. We may even say that if you are importing goods, we are charging you high transport fare. When we are charging you the high transport fare, we expect that some people will just ignore the importation. And when they ignore the importation, you are also reducing on the imported inflation. Then the other thing, we can set our own substitutes. And these substitutes, they will be substituting the goods that we were formerly importing. If let's say we set our own companies that can produce what we've been importing, then we can reduce the imported inflation by using the import substitution strategies, so that we produce whatever we've been importing, we produce them locally. The other one we can talk about, we subsidize. Because I know in these low developing countries, we expect that they cannot do without importation. So what the government should do, it should provide subsidies in form of incentives. They give them something that by the time they bring in goods, at least even if they are of a high price, you subsidize them or you assist them so that the final product of the final cost of the product becomes a bit low, which will also lead to a low prices. The other one, we can talk about encouraging use of domestic raw materials where possible. In this, we can do it in a sense that when you have, let's say we have the fixed or the scarce resources, but at least use those resources and make sure you make more goods out of those few items you have. Because if you use, let's say, mechanization and you bring in some advancement or some innovations, then you try to add in something, you use less, you control the wastages so that you can produce more as compared when you're using the traditional ways. The last one we can talk about, economic integration. And this economic integration, we are looking into creating those trade unions whereby you can be selling those goods within the integration or within your corporation, and you charge yourself a less price as compared to whatever price they will be selling outside the integration. This is the last classification of inflation as per the causes, and this is where this is suppressed inflation. Suppressed inflation, this is where the excessive persistent increase in the general price level of commodity is controlled by the government through the use of price control. This is mainly a control measure whereby the prices are controlled by the government through the use of the maximum and the minimum price legislations. We have also open inflation. This is where inflation is not controlled by the government through price controls, rationing, and other means. This open inflation is just the opposite of the suppressed inflation. I wanted us to look at some of these concepts, the concept of stagflation, the concept of deflation, the concept of reflation. First of all, stagflation, this refers to the economic situation in which high inflation rates coexist with high levels of unemployment. It means that the economy is facing two challenges at the same time. They have high rates of inflation, and at the same time, the unemployment is high. So with that, then you expect that people are going to be crying more and more and more, because first of all, when you have the prices are high, but people, they don't have even what to do, or the people are not even working. How do you expect those people to be paying those prices which are already, or buying those goods which are expensive? Then you just find that the economy is just stuck, because first of all, the items are expensive and the people are not working. They don't have money. The disposable income is not there. Then how do you expect them to survive? So it is caused by a decline in aggregate supply, which leads to a decline in the output, hence unemployment due to layoff of workers. This happens as a result. If, let's say, the aggregate supply reduces, when the aggregate supply reduces, we expect that people are not going to be working. First of all, because if you're not supplying, then you don't expect to be employing people. When you are not employing people, then even those who are working, some of them, you terminate their contracts, you lay them off. And when that happens, you expect that the workers, first of all, the cost of living is going to be high. The standard of living is also high. The cost of living is going to be increasing, but the standard of living is going to be low, because people, they don't have what to eat. They cannot even access even the medication, because at the end of the day, the prices for the medication is high. Then their wealth, or even their health conditions are going to be affected, meaning the standard of living, how people live, is going to be completely bad. Then we expect that even the investment, because if you are not supplying, then what happens is that even those companies which, if you're not supplying, then how will you continue in production? Then those companies, they will also decline. As those companies are declining, you don't even expect investors to come in so that they can put in their own monies. Don't expect even people to save, because someone is not working. How can you expect someone to save? That's that scenario, or the concept of stagflation, where is a situation where an economy is facing inflation rates being high and the unemployment rates being high. Then we have the deflation. Deflation, this is the persistent fall in the general price level of goods and services. This is the opposite of inflation. The opposite of inflation is deflation. The other one is persistent increase. This is persistent decrease or reduction. Then you have reflation. Reflation, these are the policies the government uses to make sure that it uplifts the economy from the depression or the deflation. Those methods, if, let's say, the prices are falling down each and every time, what we can do, some of these policies, what you can use, you can say, let me increase the money supply. When you increase the money supply, of course, we expect people to raise their purchasing power. When you reduce the taxes, you expect that people are going to be having more money. So some of these solution to deflation. They are the causes of inflation. So I hope you can analyze that one by yourselves. Then these ones, the general causes of inflation, allow me just skip this one because we've been talking about them. That's because we've been giving one by one, and we give the causes and the solutions, meaning we are not going to talk about the causes and the solutions. Those ones you can just make them on your own. Maybe to just give you a, to just list them, we have excess printing of money. Here we are talking about the causes. That is the increase in money supply. Increase in the cost of production, that is the cost push inflation. Persistent political instability, that one is understandable, because when there is political instability, you expect that there is a structure, there is supply rigidities. Importation of commodities and raw materials from countries experiencing inflation, that is imported inflation. We have supply rigidities due to bad weather, pests and diseases, poor infrastructure, and others. Excessive aggregate demand for goods and services compared to their supply, that is demand pull inflation. So I know those ones are very easy for you to guys to pick. Allow me to leave those ones. We said you're seeing here, these are some of the control measures, how we can control inflation. We said selling government securities to the public. That one is use of restrictive monetary policies, whereby you can sell the treasury bills and bonds to the public. As you sell those securities to the public, you are removing money from the circulation. Increase in direct taxes. When you increase the direct taxes, that is the use of restrictive fiscal policy, whereby you are reducing the disposable income of the people. Then reducing government expenditures. You don't give out money to the public. When you reduce that, meaning you are reducing the money supply in the economy. Maintaining political stability and security. Use of import and export policies. Use of population control measures to reduce the aggregate demand. Use of import and export policies. That one I've talked about it. Use of price and wage control measures, like the maximum price and wage legislations. Use of, this one is always the last one. Use of currency reforms. Currency reforms comes as the last resort. Why? Because you cannot, if there is an increase in the salary, and let's say, sorry, in the general price levels, and you just change the currency, you are not solving anything, because at the end of the day, you will keep on changing. This one comes if you have done everything we've said above, and you see that the inflation is still existing, then the last resort is to change the currency. Okay, allow me to talk about the effects. Effects, we can talk about the implications. In these implications, those are the effects. We may be having a positive effect or positive implication of, as I said, the mild inflation is good to the economy. Why is it good? These are some of the reasons why mild inflation is good. But we say the hyper inflation or the runaway state of inflation is bad. So for the positive effects, we are giving the mild inflation. It stimulates production of goods and services in the economy due to high prices and profit margins. Let me zoom a bit. I hope you guys, you can see them clearly. But that's much. At least from there, you can see them. We said it stimulates production of goods and services in the economy. Why? Because when the prices are increasing slowly, we expect that these producers are going to be getting more profit. As they get more profit, they will be producing more items. As they produce more items, they are also benefiting, they are getting their profit, and we are also getting our taxes. Because when they get more profits, we expect to tax those profits and we get our revenue as government. It stimulates people's effort to work. I said if the price of the commodities are high, then we expect people to be working so that they can earn a living. Because when the prices are increasing, we expect you to be paying at least some amount of money. When you're paying out that amount, then we are expecting at least you have to work hard so that you can earn a good standard of living. The other one, it is a source of employment opportunities. This comes as a result of, because since the profits are there, we will expect that the investors are going to come in to make the investment, and the production is going to be increasing. As the production increases, it will be giving our workers employment by engaging directly in the production of the goods, hence creating an increase in the employment opportunities. The fourth one we can talk about, it increases government levy. That one I talked about it, because as the profits are increasing, we expect that the government is also going to get more profits, more revenue in form of taxes, which can be used for financing the recurrent and the capital or the development expenditure. These recurrent, those are the day-to-day operations within the state, and the development one, those are the long-term plans or long-term expenditure that are incurred, let's say on construction of roads. But these other ones, these recurrent expenditures, they may include paying government workers salaries and others. The other one we can talk about, it encourages forced savings as a result of high profits, because when you are getting the profits, we expect to be saving some of the profits you are getting, so that you'll be having more and more money, which can be again reinvested in the economy so that you can grow up. The other one, it also stimulates the entrepreneurship skills. Why? Because when the people are engaged in production, we expect them to be innovative, to produce more and more varieties of commodities. So as they think, or as they are investing in the company, in the economy, we expect that we are going to be improving each and every time. So there is also labor mobility. This labor mobility comes in as a result of even those people who are in the villages, they will be coming in towns to look for those companies which can pay them highly. Because when the prices are increasing, we expect that people will be looking for a better standard of living. And when they are looking for that better standard of living, they have to look for other employments which can pay them highly, because we said that the investments are there. So when the investments are there, the employments are created, so it will facilitate people to move from one job to another so that they can settle where they are comfortable and they are being paid well. So there is also utilization of the available resources. We said when the prices are increasing, we expect that everyone is going to be engaged in production. When they get engaged in production, even those raw materials which were not used, people will use them up and they produce more goods. So we are expecting that the scarce resources we have, we are going to utilize everything so that we can increase our profits. But there is also a bad something and within the good one, because there is There is borrowers. These borrowers, the people who get, let's say, loans. When they get loans, the borrowers themselves, they stand to gain. They start gaining. How? They start to gain because when the prices are increasing, we expect that even the interest rate is going to be losing value. Because if, let's say, someone gave you a loan of 10 million and that 10 million could buy something, and when there is inflation, we expect that that money is going to lose value. When that money loses value, the amount you are paying does nothing, because you may see that by the time you took that money, it was doing something, but since the inflation is increasing, that money has lost the value. So you are paying as if it's a bad thing, but for you are getting out of it. Then let's talk about the negative effect or the impacts of inflation. Here we are going to be talking about the hyper or the galloping or the runaway inflation. This is the bad part of inflation, where the inflation increases at a very high rate exceeding 20%. First of all, there is low standards. We expect low standards of living because people cannot afford to buy what they can use. We expect that people, they cannot afford to buy what they want to use because the cost of living is high. And when the cost of living is high, you expect that since people, they don't have even what to do, they will be able to consume poor commodities. And when they consume poor commodities, they will be reducing on their standard of living. Because when you talk about the standard of living, is not concerned about the cost we are spending, but how well are we, depending on the cost we are paying. If, let's say, I'm paying something, is it doing me something good, or I'm just paying that cost because that's the only money I have? The other one we can talk about, it discourages savings, as we said, because if let's say the money has lost value, why are you keeping the money? You better keep the items themselves, or you better buy goods and equip goods than holding money. Because keeping money, you may keep today 10,000, and that 10,000 today, maybe it was buying, let's say, book. By the time you remove that money tomorrow, you may find that it cannot even buy that book. So it discourages savings. You don't keep the money, you rather spend the money and buy few goods. The other one, it worsens the balance of payment. It worsens the balance of payment position of the country, in the sense that if your exports are expensive, then the investors or the people who are buying, the importers, are going to be discouraged. When they get discouraged, it means you are going to be receiving less foreign exchange earnings from your imports. I mean, from your exports. When you earn less, remember, you are also importing. When you are importing, you may find that for you are spending more than what you are getting from your exports. And if that happens, then we will be having a deficit balance of payment. And if we have that, then that is the worst part of the balance of payment position of the country. Then the other one, it increases the level of unemployment. As we said, this level of unemployment comes in as a result of even those companies which were working, because there is high prices and people are not buying the items, so they can shut up the business. And when they shut up the business, or when they close the business, we expect that they are going to lay off the workers. And when the workers are laid off, we expect that they are going to be in the situation whereby they don't have what to do and they will just be unemployed. It encourages dumping. Dumping is a situation whereby certain companies, if let's say someone has a higher price, you may find that people may bring in goods and they sell the same goods at a low price than what you are selling in your country. Because if there is inflation, we expect that the prices are going to be high. So these people who are bringing in goods or the imports, they may sell them at a cheap price compared to what you are selling. And when they do so, it means you are going to lose the market, and for them, they will be selling. And when they are selling, it will be a problem to you, because for them, they will be getting money and for you are not getting, because your prices have been increased. That's what we call the dumping. And the other thing we can talk about, it creates or it leads to income inequality. And this income inequality comes in as a result of those who are paid less, they become poorer, because at the end of the day, you are earning less and it is fixed. It cannot be even adjusted. So those who are poor, they remain poor. And those people who have been paying well, or who have their salaries which can easily be adjusted, they will be having more income, which will create a gap between the rich and the poor. And that's the income inequality we are talking about. Then there is also rural-urban migration. It comes as a result of those people who are somewhere and their pay are not enough. They'll keep moving from villages to town, because you may find that when they produce, let's say, agricultural output, they don't earn much. So by that time, they just leave whatever they are doing from there and they just come in town, which will eventually lead to an increase in the price. Because at the end of the day, people, when there is rural urban migration, we expect that the towns are going to be overcrowded. And when they become overcrowded, because the people wanted to look for better paying jobs in towns and urban centers, then it will be a bad situation to the economy. Then this is going to be the last slide. We're going to be talking about why is it hard to control inflation in developing countries. What makes it hard for inflation to be controlled in developing countries? One of the reasons why it is hard to control inflation in developing countries is because there is a need to import essential commodities and raw materials in the country. There is a need for importation of those raw materials and commodities which are lacking in the country. If the country cannot, let's say, own some of these materials and they are essential, you can talk about the petroleum products. If they can't own them, then they have to import them. And when they import, we expect that they are going to be bringing the imported inflation, because they will be willing to buy at whatever price. So when they are willing to buy at whatever price, it creates the inflation. There is also high rate of rural urban migration, which increases the cost of living in towns, hence inflation. People are living in villages and they are coming to towns or to urban centers. And when that happens, first of all, they are increasing the population in that area. Secondly, they are making the cost of living to be high, because as the people are increasing, we expect that the demand is going to be increasing. And when the demand increases, then the prices also for the social welfare are going to be increased. And when they increase, the cost of living is also going to be high, hence leading to inflation. The other one, we can talk about low productivity in the agriculture sector. Because most of these farmers, you see, they use the traditional means of farming, and when that happens, it means they are going to be producing less. When they produce less, we expect that the prices for the agricultural products or for the food products are going to be increasing, and when they increase, that results into an inflation. The other one, we can talk about high levels of corruption and embezzlement of public funds. That money, there is a lot of corruption and embezzlement whereby there is misuse of the money. Someone sets, let's say the government puts a certain amount of money for, let's say, for people with, or to fight, or to increase, let's say, agriculture or improve agriculture, but people misuse that money and people eat the money and they don't really do what the money is supposed to do. So when they do so, we expect that the production is going to stay poor, and the people have not received the service they are supposed to receive. So it's going to increase the prices. As a result, to increase the prices, we expect that the inflation is going to be resulting. Then there is also a need by the government to have more levy. If the government wants to increase its levy, what they do, they charge those, or they increase the taxes. When they increase the taxes, then it means the cost of production and the selling price, they are going to be high. When that happens, then we expect the inflation to be setting in. Then the other thing, we have political instabilities and insecurity, whereby we spend all our money trying to see how we can reduce those, which doesn't make people or investors come in so that they can increase their productivity. And when that happens, you just know that the general price level of goods and services are going to increase. As they increase, then the inflation will be appearing. The other one, we can talk about the poor infrastructure, like roads and others. When these, most of the transport and communication networks in the low developing countries, they are poor to the extent that even if you have produced the materials or the finished goods, you cannot supply them to the people who need them. And as that leads to an increase in the price in those places where they are hard to reach. So I hope those things makes you a bit get a picture of whatever they can ask about inflation, because I know we've handled everything, and I hope to stop here for today. I want you guys to subscribe to this channel so that you can be getting more and more, because we are going to be dropping more videos so that everyone can be benefiting. You can share the videos to others so that they can also have a benefit as you benefited. And that's all for today. Thank you, and bye for now.